Welcome back. You're watching the Money Show with me, Kavita Thapliyal, and we move on to our next topic. Equity markets have remained highly volatile this year, and with several global indicators turning negative, chances are that investors will continue to see wild swings in the market going ahead. Now, in such a scenario, where should you as an investor think about putting your money? What are the few bright spots, sectors, and themes where you can look at investing your money? Let's answer all of these questions with Tarun, founder and CEO, TBNC Capital Advisors. Tarun, good evening and welcome to the show. I know it's very difficult to actually recommend sectors and themes to investors, the kind of volatile times we are into. But then because you're an expert and you've answered several of these questions earlier also on the show. So tell us, looking at the market currently, what are those sectors or bright spots where you think investing at this particular time can maybe give you handsome return in a couple of years?
So thank you, Kavita, for having me here. So while on the outside, we see the Nifty 50 remaining flat or somewhat negative in the last 1.5 years and having hardly moved anywhere from October 2021, right? So, however, when you look at closely, we are going through a very, very classic case of VITS. And this is V means heightened volatility, I means raging inflation, T means there is an unprecedented monetary tightening, and S means supply chain disruption. So these are four very big actions which has happened in last 1.5 years. And again, the supply chain disruption is uh, due to Russia-Ukraine crisis. So amidst this, to call out any clear-cut sectoral winner is very difficult. And there have been periods of under and outperformance of various sectors in this period. Okay, so as we speak today, the present scenario is characterized by three, four big themes. One is rising cost of capital, falling energy prices, rising bullion prices, as well as the bond yields are also going up. So, and you are seeing finally equity markets are also going down because of these unattractive yield gaps. So, when this equity market is going through a downturn, at that time you find favors in sectors like utilities, consumer staples, healthcare, and all these sectors get a lot of leadership in this period. So, because these sectors offer stable earnings, dividends, and making them attractive for investors looking for safety.
Right. So over here, it's not only safety, but then we are also talking about getting better returns in the future. So now, if someone has their portfolio sorted in terms of getting all the basics right and having a portfolio right in place, how can one diversify sectorally or maybe theme-based diversification?
So I'm not a big believer of going sectorically from time to time or theme oriented, because I would rather look at somebody more diversified approach and give that freedom to that fund manager to actually take that call which sector becomes attractive at what period of time. And again, for investor, it is not a very tax efficient strategy, and the impact cost is very heavy in terms of getting in and getting out for a normal investor. So my strong suggestion is to stay for a more diversified approach. But nevertheless, I will try to give my perspective of various sectors. So let's start with the first sector, the banking sector. So banks has demonstrated robust performance both on the earning side as well as the price performance. The rising interest rates is definitely going to impact the credit growth, but the NPA cleanup as well as strengthening of balance sheet of corporate India is definitely something which is giving us a lot of positives in terms of looking at banking sector. So I feel banking sector is there for a very strong run in coming years, and if India has to become a $10 trillion economy or a $7 trillion economy, banking is going to be one of the most attractive segments to look at. And with the deleveraging cycle, that is definitely an attractive sector. Second sector, which I will definitely look at, is the manufacturing side, because we are seeing very strong demographics in this country, as well as the strong domestic market, as well as competitive labor cost, as well as favorable government policies. We are seeing the government policies has been one of the best in last 15, 20 years, right? Where you are seeing a lot of positive actions happening, and you can see the foreign investors investing in the market, manufacturing thing with the there are issues happening in China and all that global equations changing. We are seeing newfound love for Indian manufacturing coming in. So that sector, according to me, is one of the very favorite for me. And next 3-4 years would be very strong for this sector. Coming for IT sector is another third theme which I feel is looking attractive to me, because last 1 year I have seen it has fallen by, if I talk about index, has fallen by almost 20%. And definitely India has a arbitrage against the global IT majors, and we have definitely a strong a human resource to take care of that. And this gives us a lot of attraction compared to other markets. And with the cost reduction happening, work from home happening, I can visualize these IT companies, their margins and everything are going to get better only. So IT sector also with this fall, it could be something one can look at. Another theme which is like the pharma has also been 17-18% from a sector point of view is down, but India definitely have some very strong pharma names with good leadership position that also looks very attractive to me. Telecom is another sector where we can see there is a lot of consolidation. Top two players have 70% of the market share, rising ARPUs, and these players will be key beneficiaries going forward. So I feel these 4-5 sectors uh, clearly are looking very attractive to me right now. And with last 1.5 year time correction happening in the market, and apart from that, earning upgrades also happening. Uh, I can see there are very attractive opportunities in sectors available. Nevertheless, I am not a strong believer of specific sector funds. I would strongly recommend to go for a good diversified fund manager. Let that fund manager pick up the best stocks in that market. Thank you. But you need to look at individual fund performance, expense ratio, risk ratios, and fund management quality, and they need to be aligned with your financial goal as well as suitability. Those are very critical points.
So how can one do it? Now the kind of sectors you highlighted, one thinks of investing themselves in a sectoral fund, or maybe, try experimenting a particular theme. What should be your checklist? Right from picking up the AMC to the fund manager to seeing what kind of a strategy they have to the risk involved in a particular theme, because this investment is not going to be a short-term investment. We are not talking about something in a time frame of 1 to 3 years. It has to be 5 plus. For a theme to play out the kind of benefits that you want, you really need to have a longer time horizon. Considering this is the time you might want to enter, what should be your checklist?
So I think we started, Kavita, with that main observation that suitability is most critical, and once the suitability is in place and the core and satellite approach has been strongly identified, the satellite option can always look at options which can give you options in the current market environment which are looking more attractive. But nevertheless, maybe one can look at different ways to capture this. One is the market capitalization oriented approach on a core and satellite way. On the satellite approach, I can look at themes like small cap oriented funds, which are much more riskier in nature. But at times, when tactically picked up at the right time and with the right macros, they are definitely going to give you better returns compared to large caps. So that could be one approach. And second approach could be like I picked up, let's say, themes like manufacturing, IT, banking. All these themes are good enough, but my observation has been that timing plays some bit a role in this part, and investors naturally are not able to enter at right time and enter exit at the right time. Due to that, I would prefer a strong fund manager to pick that up in their diversified fund at that same time, and maybe you can benefit from that capture of that sector.
All right, so that's the view. If someone wants to have allocation in sectors or maybe a theme-based fund, and on that note, thank you so much Tarun, for being on the show and helping our viewers on this strategy. We'll take a quick break, and after that, let's get your questions answered by Kostubila.